Welcome to Wealth Building Wednesdays, where we move beyond vague financial advice and turn your money into something you can understand, measure, and direct. Today, we are going to calculate one of the most important numbers in your financial life, your break-even number. Because before you can build wealth, you need to know exactly what it costs to keep your life or your business financially standing. If I asked you right now, what is the minimum amount of money you need every month? Could you give me an exact answer? Not a guess, not around $3,000 or $4,000, not whatever your last paycheck happened to be. Could you tell me the precise amount required to cover your essential personal obligations? Could you tell me what dates that money must be in your bank account? And if you own a business, could you tell me how many sales you must make before the business has paid for itself? If not, you may be working hard without knowing where the financial finish line begins. Your break-even number is the amount of income required for your available money to equal your required expenses. At break-even, everything that must be paid can be paid, but nothing meaningful is left over. You are not necessarily building savings. You are not paying extra toward debt. You are not investing. You are not yet creating financial margin. That means break-even is not the wealth goal. It is the baseline that tells you where wealth building can begin. If your monthly break-even number is $4,000 and you bring home $3,700, you do not have a discipline problem to solve with positive thinking. You have a $300 gap that must be addressed. To make this number useful, I want you to calculate 3 different levels. First is your survival number. This covers only the expenses required to keep you housed, fed, insured, transported, medically cared for, and current on minimum obligations. Second is your true break-even number. This includes your necessary bills plus realistic variable spending and the monthly share of expenses that do not occur every month. Third is your stability number. This adds planned savings, protection against irregular income, and modest financial margin. These numbers answer 3 different questions: what keeps me safe, what keeps me current, and what allows me to stop living at the edge. The first step is not estimating. It is gathering evidence. Collect at least the last 3 months of bank statements, credit card statements, pay stubs, bills, and payment app transactions. If your expenses change significantly throughout the year, review 6 to 12 months. Why? Because memory is selective. We remember the rent. We often forget the annual registration, quarterly insurance payment, subscription renewal, school expense, copay, or small automatic charge. Your break-even number should be based on what your life actually costs, not what you hope you normally spend. Next, list your fixed essential expenses. These are obligations that are usually the same or close to the same every month. Rent or mortgage, car payment, insurance, phone, internet required for work, minimum debt payments, childcare, and other contractual obligations. Do not leave out a bill simply because it is currently late, deferred, or temporarily being covered by someone else. If the obligation belongs to you and will return to your budget, include it. Write the monthly amount, due date, payment method, and the account from which it is paid. Now, calculate essential expenses that vary: groceries, electricity, gas, transportation, prescriptions, household supplies, and other necessary spending. Do not use your lowest month. That creates a number that only works when everything goes perfectly. Review several months and choose a realistic baseline. You may use the average, but if the expense regularly fluctuates, use the higher normal amount. For example, if your electric bills were $140, $165, and $210, budgeting only $140 would understate your need. A baseline closer to $175 or $180 may be safer. Precision does not mean pretending every month will be identical. It means planning honestly for normal variation. This is where many budgets quietly fail. Some expenses are real even though they do not happen monthly. Car registration, annual memberships, school costs, holiday spending, property taxes, quarterly insurance, professional fees, maintenance, and medical deductibles. Convert each one into a monthly amount. If a $1,200 insurance payment is due once a year, divide $1,200 by 12. That expense costs your life $100 per month. even if the bill is not collected monthly. If car maintenance averages $600 a year, that represents another $50 per month. These monthly set-asides are often called sinking funds. Without them, predictable expenses keep disguising themselves as emergencies. Now review your spending and separate it into 3 categories. A need protects your basic health, safety, housing, transportation, or ability to earn income. A commitment is an obligation you agreed to pay, even if it is not essential, such as a contract, financed purchase, or minimum debt payment. A choice is flexible spending that could be reduced or paused without putting your immediate stability at risk. This is not an exercise in shame. You are not proving whether you deserve a streaming service or a meal out. You are identifying which expenses can move when income does not. When everything is labeled essential, nothing can be adjusted. Now add the numbers together. Your true personal break-even number equals fixed essential expenses plus your realistic variable baseline, plus monthly set-asides for irregular expenses, plus minimum required debt payments and other commitments. Suppose Maya has $2,000 in fixed essentials, $900 in variable essentials, $300 in monthly irregular expense set-asides, and $400 in minimum debt obligations. Her personal break-even number is $3,600 per month. That is the minimum required to keep her current obligations funded without borrowing from next month. Next, list every source of income, but use the amount you can actually spend. For employees, that normally means net pay after taxes, insurance, retirement contributions, and other deductions. For business owners, gross revenue is not personal income. The money collected by the business may still need to cover expenses, taxes, refunds, payroll, or inventory before you can pay yourself. List wages, consistent owner's pay, benefits, pensions, support payments, rental income, and dependable side income separately. For every source, record the expected net amount, frequency, typical payment date, and whether it is fixed or variable. Income frequency matters. If you are paid weekly, multiply your normal weekly net pay by 52 and divide by 12. If you are paid every 2 weeks, multiply one paycheck by 26 and divide by 12. If you are paid twice a month, multiply one paycheck by 24 and divide by 12. But remember, a monthly average is useful for planning the year. It does not tell you which paycheck must cover which bill. And if your income changes, do not automatically use your best month. Use a conservative baseline, such as the lower end of your normal income or an average that excludes unusually high months. Now compare dependable monthly income to the personal break-even number. Maya's net income is $3,900. Her break-even number is $3,600. That leaves $300 of monthly margin. The calculation is important because a positive bank balance can create a false sense of safety. If some of that money is already needed for a bill due next week, it is not truly available. Your balance tells you how much money is in the account. Your break-even plan tells you how much of that balance already has a job. This next step turns your break-even number into an operating system. Create a calendar showing every pay date and every expense due date. Then mark automatic drafts separately. Do not only ask, "When is this bill due?" Ask, "What day does the money need to be in the bank?" If rent is due on the 1st but your bank processes the payment overnight, the money may need to be available by the last business day of the previous month. If an automatic insurance payment drafts on Monday, relying on a deposit arriving Monday afternoon may leave you exposed to an overdraft. Your cash available date should normally be earlier than the due date, not the same day. Once the dates are visible, look for timing gaps. You may earn enough over the entire month and still be short at the beginning of the month. Suppose Maya receives $1,950 on the 5th and another $1,950 on the 20th. Her income exceeds her $3,600 break-even number. But if $2,200 in housing, insurance, and automatic payments must be available by the 3rd, her first paycheck arrives too late. That is not an income total problem. It is a cash flow timing problem, and timing problems require a different solution. Now assign each expense to the paycheck that must fund it. Bills due before the next paycheck belong to the current paycheck, even if the bill is technically due next month. For example, Maya's paycheck on the 20th may need to fund rent due on the 1st, because she will not receive another deposit until the 5th. This changes how she sees that paycheck. It is not extra money at the end of the month. Part of it belongs to next month's rent. If one paycheck cannot cover everything assigned to it, you have several possible levers. Move a due date, divide a payment across paychecks, reduce an adjustable expense, build a one-paycheck buffer, or increase income. But first, the gap has to become visible. If you own a business, you need a separate calculation. Your personal break-even number tells you what your household requires. Your business break-even number tells you what the business must generate to cover its own costs. Do not combine the two bank accounts and call whatever remains profit. That makes it difficult to see whether the business is financially healthy or whether personal money is quietly subsidizing it. The business must first cover its operating costs. Then it must be able to compensate the owner. Those are related but separate financial thresholds. Begin with fixed business costs, the expenses the business owes regardless of how many sales it makes. These may include rent, software, insurance, licenses, bookkeeping, base payroll, website services, professional fees, loan payments, phone service, and required subscriptions. Review actual business statements. Do not leave out expenses you paid personally. If you regularly pay for business software with a personal card, it is still a business expense. The payment method does not change the purpose of the cost. Add the monthly portion of annual and quarterly business expenses as well. Next, calculate what each sale costs you to deliver. These are variable costs because they increase when sales increase. For a product business, that may include inventory, packaging, shipping, transaction fees, and sales commissions. For a service business, it may include contractor labor, materials, mileage, payment processing fees, or software charges tied to the client. Suppose Marcus charges $500 for a service. Delivering it requires $150 in contractor labor, $25 in materials, and $15 in processing fees. The sale produces $500 in revenue, but only $310 remains to help cover fixed costs. That remaining amount is the contribution margin per sale. Now we can calculate the bare minimum number of sales required. Divide total monthly fixed business costs by the contribution margin per sale. Suppose Marcus has $4,650 in monthly fixed costs. Each $500 sale contributes $310 toward those costs. 4,650 divided by 310 equals 15. Marcus must complete 15 sales to cover the business's fixed operating expenses, not 9 sales. 9 sales would produce $4,500 in revenue, but revenue alone does not account for the cost of delivering those services. This is why dividing expenses by the sales price can produce a dangerously incomplete answer. 15 sales keep Marcus's business operational, but they may not pay Marcus. This is one of the most important distinctions in business finance. An operating break-even target covers the business. A sustainable break-even target covers the business and includes the owner's required compensation, tax planning, debt obligations, and appropriate reserves. If Marcus needs $3,600 in owner's pay, that amount must be incorporated into the business model. Otherwise, the business may appear successful while the owner continues paying personal bills with debt or savings. A business that only works when the owner goes unpaid has not reached true sustainability. Let's add Marcus's $3,600 owner compensation to the $4,650 in fixed business costs. The business now needs to produce $8,250 in total contribution margin. Divide that by $310 of contribution per sale. The result is 26.6. Because Marcus cannot complete 6/10 of a sale, he must round up to 27 sales. 15 sales cover basic business operations. 27 sales cover business operations and planned owner compensation. He may still need a higher goal for taxes, reserves, reinvestment, or profit, but now he can see the difference between surviving and sustaining. If your business sells several products or services, do not assume every sale contributes the same amount. A $100 product with a $20 contribution margin does not carry the same financial weight as a $500 service with a $310 contribution margin. You can calculate each offer separately or use a weighted average based on your normal sales mix. The deeper question is not simply, how many sales do I need? It is, how many of which sales do I need? This helps you recognize whether your current offer mix can realistically support the business, or whether you are depending on a high volume of low-margin sales. The business also needs its own cash flow calendar. Record when business expenses are due, but also record when customers actually pay. A sale booked on the 25th is not necessarily cash available on the 25th. The customer may pay 30 days later. A payment processor may hold funds for several business days. A contract may require work to be completed before the final invoice is paid. Sales targets measure what must be sold. Cash flow planning measures whether the collected money will arrive in time. A profitable business can still experience a cash shortage when income arrives after expenses are due. Once you have the calculations, put them into a simple monthly dashboard. For your personal finances, track your survival number, true break-even number, stability number, expected net income, current BAP or margin, next pay date, and amount required before that date. For your business, track fixed costs, average contribution per sale, operating sales target, sustainable sales target, sales completed, payments collected, and upcoming cash requirements. These numbers should be visible before spending decisions are made, not discovered after the account is empty. Your dashboard turns your finances from a reaction into a management process. If your income is below your break-even number, do not hide from the result. The number is not a judgment, it is a diagnosis. First, determine whether the problem is temporary, structural, or related to timing. A temporary gap may come from a one-time expense or delayed payment. A timing gap means sufficient income exists, but it is not available when bills are due. A structural gap means normal income is consistently lower than normal required expenses. And choose the correct lever. Reduce or renegotiate an expense, move a due date, change the sales mix, raise pricing where justified, increase sales volume, add dependable income, or create a phased debt reduction plan. The answer may require more than one lever, but clarity prevents you from trying to solve the wrong problem. Knowing your break-even number does not mean you should aim to live there permanently. Break-even is the floor. Once the floor is consistently covered, the next dollar should be intentionally directed toward protection and growth. Emergency reserves, debt reduction, retirement, investments, business reserves, planned expansion, and long-term goals. Without a defined baseline, extra money tends to disappear into unplanned decisions. With a baseline, every dollar above it can be assigned to building something. That is where the connection between break-even and wealth becomes clear. Your break-even number creates freedom because it gives you a boundary for financial decisions. It tells you whether a new expense is affordable. It tells you how much income a career change must replace. It tells you how much cash you need before taking time away from work. It tells a business owner whether the current price, cost structure, and sales volume can support the business. And it replaces the vague pressure to make more with a specific question. What must change for this number to be covered consistently? And what can I build once it is? Financial freedom does not begin when you become wealthy. It begins when your numbers stop being a mystery. This week, do not begin by trying to build the perfect budget. Begin by answering 5 questions. What are my required monthly expenses? What reliable income do I actually receive? When does that income arrive? What dates must money be available for my obligations? And if I own a business, how many sales and which types of sales must I complete to cover the business and properly compensate myself? Write the answers down. Put the dates on a calendar. Calculate the gaps. You cannot direct a number you have never identified. Your break-even number is not meant to limit you. It is meant to give you solid ground from which to build. Calculate the number, respect the timing, close the gaps, then give every dollar above the baseline a purpose. Subscribe for more Wealth Building Wednesdays and connect with TLJ Professional Services when you are ready to move from financial guessing to financial clarity. Because wealth is not built by accident, it is built when your money has a plan. Ready to take your next step? Explore TLJ's course subscriptions. Complete the 5 Signs Diagnostic Checklist to see whether your finances need a one-time cleanup, or schedule a personal consultation with our team. You'll find each option in the description below. Choose the support that meets you where you are. And let TLJ help you move forward with clarity.